Hello, everyone. Good evening, and welcome to episode number 7 of Inside Out. My guest tonight is one who can say that he's seen it all and done it all. He was down in the dumps early on in his life, invested some money in the stock market, faltered, but that did not deter him. He defied the odds, went back in again into the stock market. I must say, his second innings has been fantastic. He's created a lot of wealth for himself. And now he's using his experience over 2 decades and advising thousands of clients in investing in the stock market. He's also authored a book called The Thoughtful Investor, which I must say is a fantastic read. It's not only a fantastic read, but there are a lot of learnings to be had if you care to grab a copy and read it. It's my pleasure now to present to you Basant Maheshwari. Welcome, Basant, and it's great to have you on the show. Life was good.
Thanks for having me, Raman.
Yeah, life was good. You and your family were sitting on a multi-crore mining business, but then one stroke of a pen by way of a government order turned all your lives upside down, didn't it?
True, it was, but it's got more to do with my father passing away. When you deal with the bureaucracy and you deal with the government, you need a person who understands how the bureaucracy and the government functions. A young, impatient, restless guy like me always used to ask कि इतना time क्यों लग रहा है, ये क्यों देना है ये होने के लिए, and you know how government functions, how bureaucracy functions. So I think in hindsight it was more of my short-sightedness that I did not know how to figure out my ways across the corridors of power, and that is how it all happened.
Yes, your first innings into the stock market was not a great outing from what you've written in your book. But again, you went back after a while, and then there was no looking back. A lot of learnings from your first faltering in the market.
Everybody comes to the market to make money. It's quite unlike cricket, right? So cricket, you develop a love for the game and you start playing, and if you play well, you get paid well. In stock markets, we might all say we are very passionate, we love stocks, we do stocks 20 hours out of, but the first invitation to the market is to make money. You're lured by the greed. So in 1992, when I was in college, so the Harshad Mehta boom had come across, and then at that time you always knew if you buy a stock worth 20, you might sell it at 30. So it's a 50% return in 10 days, 15 days, 20 days. So, and plus, there are stories about people saying that the money, if you bring to the market, should be the one which you can afford to lose. But I feel if you bring to the market the money which you can afford to lose, you will lose it. You have to bring the money to the market which you cannot afford to lose. In this case, you're going to look at a little more perspective on risk and return.
Yes, but you are determined to get back to the stock market, and obviously your background in accountancy, also helped you to have an edge over others in terms of reading various factors.
I mean, it does appear from an outside perspective that an accountancy degree or an MBA degree helps you, but these degrees normally, for example, an MBA for 2 years or an accountancy for 3 years, for 4 years, you are taught about risk, and risk. So avoiding risk, you can't make money. Taking too much of risk, you'll blow yourself up. So you always have to evaluate the right balance between risk and return. It's like, there's no one surer way to reach heaven. And even for example, if I'm too risk averse, what do? I wouldn't even keep bank money with me. I would buy only gold and put it under my pillow. What happens if I sleep at night and a thief enters my house and takes it away? So there is no end to worrying about risk, but then at some point you have to evaluate risk with return and move on.
In any success story, making sacrifices is almost a main theme. You made a lot of sacrifices yourself, despite the fact that you were making a lot of money in the stock market. Personally, that is.
Sacrifices were not made because you knew what's going to happen. The passion to actually invest money. So it's really funny in the initial years. So suppose there was an electricity bill to be paid or some payments to be made by maybe some school fees for my child. So he would say, if you pay after 1 month, you'll have to pay 1,000 rupees more. So I'd say, doesn't matter, I'll pay after 1 month. Let me put the money into the market. So the sacrifices were because you wanted to put the maximum amount of money into the market, and then it becomes, and it's a habit even now. I mean, I don't hold cash even for 5 minutes. If I get the money, I'd buy something. I don't hold cash. I just want to put it in, because unless you are in the game, you will never be able to win it. You have to be on the ground in your language to win a game. You cannot be winning a game sitting in the pavilion. So if you're holding cash, you're sitting in the pavilion, you have the 12th man, you're outside, you're serving drinks, but you have to go out and play. Whether it's a Barbados or a Perth, you have to play the game.
Very true. I keep hearing of people saying that they've lost money, and this is perhaps something like a 60% or 70% of the people keep saying that. But can every investor make money in the stock market?
No, no. For somebody who doesn't have too much of a grip, I say don't come to the markets. Being in the markets myself, I know what it takes, and it just isn't easy to make money off the markets, because more than the reasons, your emotions will kill you. For example, in March, when the market was falling, the Nifty fell from, say, about 12,000 whatever to 7,500. People were saying it's going to go to 6, it's going to go to 5. Frankly, I didn't know, we didn't know where it's going to end. But then the thing was, the moment it turns, it wouldn't give you a second invitation. You have to be into it. So you might have been the smartest kid in town. You might be understanding balance sheets and company accounts and everything. But when the time to really put the money to work would come, you would be terrified with the news flow. So for normal guys out there, I'd say if you don't know too much of it, don't do too much of it. It's better to buy gold. It's better to do FD rather than come into the markets and blow what you have. Because markets are 30% reasons, 70% emotions. And emotions you learn to control over time. Reasons you can learn anywhere.
To what extent luck plays a part?
Luck plays a part. I mean, it might play a part for you to make your first big home run in that sense. It might play a part in a back-to-back success story. But if you've been in the market for 15 years, 20 years, 25 years, luck doesn't play a part. I mean, what's the ratio of luck to, say, Don Bradman's success? You can be lucky in one game. You could be dropped at zero, score a double century, and the headlines would say he was lucky to have been dropped at zero, or the other team was unlucky. But you can't be lucky for 20 years at a stretch. See, if you need luck to make money, one day, bad luck will come and take it all back. So you can define luck that way.
You had mentioned in your book that you read hundreds of books before you really got full time into this stock market investing. I suppose it's a very important thing to know as much as possible. It's better to read a lot of stuff, isn't it?
Reading lots of books, true. But then beyond a point, beyond the first 10, 15, the incremental reading that you do. See, I know people who read 6 books in a month. If you're reading fiction, good enough. But if you're reading about the markets, if you're reading too much, it doesn't give you time to think. I think more than reading, you have to go. For example, with me, the best thing is if I go on a long walk, maybe 2 hours, I'm just walking across a riverside, if I'm somewhere else, or if I'm driving slowly, I just think. So thinking is very important about what you have read. Just reading mindlessly that I want to complete every book that I read doesn't help. But reading gives you a perspective on how the big guys have done it in life. But WV, the problem is when you read a book, so between 1929 and 1932, the chapter finishes in 30 minutes. But each of those 3 years had 24 hours, and each of those hours had 60 minutes, and each of those minutes had 60 seconds. For example, from March to June, like we are, 3 months spending this, 3 months being fully invested like we are, it's not easy. But if somebody writes about this COVID theory and its impact on the stock market 10 years from now, it won't be the same thing as actually passing through it. So while reading is important, you have to pass through it also. But many times it used to happen that when I used to read a book and when the markets used to fall, I used to pick up that book and say, let me see what happened in 1987 when the Dow Jones fell 22% in one day. And I would read through that again and get a feel of what it happens. But now with so much of reading and so much of looking at the markets, you know that It's like the Nazi prisoner camp story that every allied soldier used to say, "This too shall pass." So this too does pass.
So I presume that even though the market is something that doesn't operate during the weekend, you use those 2 days to do your homework.
No, there are enough things to worry for the 5 days that we do the markets to spend the last two, especially in the current environment. And for us, for people like us, Saturday and Sunday is difficult because there's so much of anxiousness of what's going to happen on Monday, what statements would come out of the Fed, what can see when the price is there moving on the screen, when there's a news flow happening, you know things are under control. When they shut the market down, then you don't know what's going to happen. So in bad times, Saturday and Sunday is very difficult to pass through, but in good times, still it's boring. It's not difficult, it's boring. So Friday evening is boring for us. Monday morning is exciting for us. So quite unlike what normal people say.
What factors does a fresher need to take into account if he wants to get into the stock market?
First is he has to stop thinking that trading the markets can make him 50,000 rupees with which he can buy a Samsung Galaxy phone. If you start thinking small, you will lose it. You have to think, okay, what do I do for me to make 5 crores over the next 10, 15, 20 years? And can I retire from this by doing that? So most people come to the markets to make 10,000, 20,000, 30,000. एक ट्रेड कर लेंगे 20,000 रुपया बन जाएगा खर्चा निकल जाएगा. The market is not your employer. It doesn't write salary checks to you. So first thing is to put money on the table. So I've seen people who do a lot of this kind of uh, fictional buying and selling of shares. It's like playing book cricket. So you can play as much book cricket as you want. You won't get too much in life. So you have to put money on the table, and obviously you have to read a lot to get a sense. But either you develop experience or you read from the experiences of others. So either one.
If you're going to study balance sheets, for example, a guy who knows to read balance sheets reasonably well, not really sort of an expert, what are the red flags that he needs to spot in a balance sheet? Because window dressing is done quite expertly by some.
I have a contrarian view to this. I mean, obviously, you cannot discount the fact that balance sheets need to be read and understood and gone through. But it's very difficult for a normal guy to. I mean, who could understand Satyam's balance sheet for 15 years? Who could understand what Yes Bank is doing for 20 years? Even the Reserve Bank of India couldn't get through it. So what do? As a normal guy on the street, you buy the best company in a sector. So anything that we speak of won't be a recommendation. It's just to illustrate the point here. So rarely you will find a red flag in the balance sheet of an HDFC Bank or a Larsen and Toubro or an Infosys or a TCS. So I'm giving these broad big names because those are the companies where the need for you to get too deep into it doesn't arise. And even if you try and get too deep into it, you wouldn't recover so much of it. But coming back to it, there are several red flags that one can encounter. The first is the return on equity, which most people may be able to figure out. So first you check is the return on equity. So if a company is generating a return on equity of less than 20%, there is a problem somewhere, unless the business itself is cyclical. So I'm speaking this for the sake of simplicity. So return on equity is the first red flag that's going to tell you. Second is you would have to buy companies that are leaders in their segment. If you buy somebody who's number 3, number 4, number 5, for example, Ultratech would always do better than the small cement plant in South India or Eastern India. So, it's like that. But broadly, I think for a newcomer, for a fresher, it's best to buy the big guys out there and not try and hit too many home runs buying the smaller turnaround companies.
I was going to ask you because I felt that would probably be a safe bet. A beginner should stick with the leaders in the pack instead of looking at stocks which are cheaper and based on tips from somebody.
No, because there's no fun in buying something which everybody knows. For example, if you tell someone buy HDFC Bank and it's going to go up, say 4 to 5x over the next 10 years, they'll say, ये तो सबको पता है, इसमें करे क्या? But सबको तो last 20 years से पता है HDFC Bank is one of the best banks in India, but still nobody's been able to buy it. So it's just like saying that people want to do something different because they assume and they think that because every effort a person puts in, he wants to generate something extra. So that's the problem. But then the bigger problem is if you try and figure out, it's like picking gold dust from, it is like picking out gold dust from a pile of sand. It's not easy because even the professionals have failed at it. And because I assume most of the guys who would be doing this would be the ones who have just entered the markets, it's best to start with the big names. And then as you develop experience, you go down lower.
Would you recommend a sector-based strategy or company-based strategy? Because there are some sectors like metals, IT, pharma. You need to keep track of a lot more things that are happening on a global scale as well, isn't it?
Very good stock market analysis. I mean, you've hit the nail on the head. See, in metals, there are 200 variables. China's GDP growth, what's the interest rates floating around. So when there are as many variables as you have, it's very difficult to actually tackle a company. The biggest money in this world has been made buying consumer stocks, pharmaceutical stocks, and financials. So what not to do is more important than knowing what to do. So if you just focus yourself on consumer pharmaceuticals and financials, I think you'll be fine. But people don't do that because everybody knows Nestle is a great company to own. But I would always want to buy that spinning mill in Tirpur, which is right now under losses and it's going to turn around in the next year. And my uncle's father's grandmother's father-in-law is still in access to some accountant there who tipped him off that this company will turn around. So more complicated the strategy, more fancy it looks.
Investing in stocks is not just keeping a tab on the ticker. You need to keep track of a lot more things outside the market, isn't it?
Many times things outside the market will give you a better indication of what's going to happen inside the market. That's because for example, a company which I bought and we made 40x on that, that's called Page Industries, that used to make the Jockey brand of innerwear. So somebody will have to come and tell you that Jockey is selling good, and then you go and you research the company there. But there are times where these analysis gives you better indication than the most astute of the experts there. But apart from that, most of the news that you hear across outside the market uh, are not worth it. For example, you'll be surprised to know we don't get newspapers at home. Not now. Now you get all the news on Twitter. For the last several years, I don't remember for the last 10 years if I got newspapers at home. Because you get all the information any which ways. It's just yesterday's newspaper, reading it today, it doesn't help anything.
You've also stayed outside Pantaloon and West Side, apparently the departmental stores or the clothing stores, to get a fair idea of what to do. And you want to gauge the sales before investing in one of them.
So this is funny because Pantaloon was owned by a first generation entrepreneur. West Side was owned by the Tatas. So normally, logically, you would say, I go and buy the Tata Group company. Why should I buy a first generation entrepreneur? But WE, the strange thing is, the first generation guys, they have the fire in the belly. They want to do something different. For the Tatas, West Side would be the seventh or the 11th item on their priority list. So of course, this was not the Ratan Tata group. This was another group. So similarly, what I used to do at that time was I used to go and stand outside Pantaloon and West Side, and I used to count the number of people coming out of a Pantaloon store and the number of people coming out of West Side store. Pantaloon beat everything hands down. So I used to take a taxi about 2 kilometers off, and I'd say Pantaloon chalo, West Side chalo, and the guy would say kaha jana hai? I said West Side nahi pata hai. Well, nahi, kaha jana kaha hai? I said Pantaloon. Bola ha, Pantaloon pata hai. So as you walked through Kamak Street, I used to ask the guy, where is West Side? So nobody would know West Side. People would know Pantaloon. And then Pantaloon had those green colored, carry bags. So the moment I used to see a Pantaloon carry bag, I would say, wow, this guy's really penetrated it somewhere. So these are things that give you an early indication. Beyond the point, they're no use. So after Pantaloon has been in existence for 5 years, for 10 years, it gives you no indication. But in the first, say, I think in the early 80s, Maggie was launched. And I remember in the mid 80s. So had we had some sense about how good Maggie would do over the next 20 years, You would have first consumed the product called Maggie and then figured out, let's go and see the company behind this product. So sometimes things outside the market give you a better indication of what's going to happen in the market.
Is there a basic time frame at all in terms of years that you need to wait for seeing tangible results?
No, it's mostly for the startup things. So the first year, the first 2 years, the first 3 years, it's good enough. So if you've been doing this for a company, like you can't be going around figuring out whether this house has been painted by Asian Paint or Berger Paint, because Asian Paints is a well-established brand. So tomorrow, if something new comes up in the world, and it's like a Tesla, for example. So if you were in US about 10 years back, and you were saying that people really think that Tesla is a great thing to own, so you would the market wouldn't tell you so much about Tesla as indications outside the market would tell you. For example, when was the first time you opened a Facebook account? You could have bought a Facebook share. But these things don't happen in India because innovation is not paramount here. Innovation is mostly there in the Western countries. So these things are the first lead indicators. They're not there to help you after a company has been in existence for 10, 15 years.
Is it fair to say that most of the investors are driven more by emotion and sentiment rather than on facts?
It depends on how you actually tackle things, because the emotion is so hard pressing. It's so difficult because at stake is all your life savings for people like us who put more than 100% of our money into stocks and only stocks. So the emotions are very heavy, but then you have to pass through cycles to understand that once the dust settles, the same market will value your stock at a higher price. But the emotions would come into you at the wrong time, and it would ensure that you don't get to make a lot of money from the markets. That's why I normally say, if you can spend 15 years in the market, 15 years without emptying your demat account, you would be very rich. But the market won't let you spend 15 years. It just won't. It's going to scare you off every second, third, fourth year.
So decision making by and large takes a lot of emotional restraint. How long did it take you to get a grip on things emotionally?
I mean, I get scared even now. When prices fall, it's fair to say, I mean, it doesn't matter. It's only a price. Like this is a famous cliche saying, buy when there is blood on the street. So my reply to that is, what do I do if it's my own blood on the street? So things like that have become so difficult in today's environment. But then the fear of being left out of the market keeps me inside the market, because I know it's great to be fearful and take everything off the table. But the moment the market turns, you won't get a second chance in. And that's what happened for the last 3 months. Nobody got a second chance in. So when 7,500 Nifty goes to 8,000, you wait for 7,800. When it goes to 8.5, you wait for 8,200. When it goes to 9,000, you wait for 8,500. And even today, people are waiting. And that's how things are.
So you need to be emotionally there, yet you will have fear. But is that the reason why some people really take bad decisions and end up losing lots of money?
The bad decision comes out of greed, WV. It doesn't come out of fear. It comes out of greed in the sense that, let's take the same example again. So if I say, why don't you buy an Ultratech, and why would you buy a small Kalyanpur cement, which was there in operation about 25 years back? People say, I mean, everybody knows that Ultratech is a great company. Everybody knows HDFC Bank is a great company. Let me go and buy that isolated, that turnaround company. So greed kills you. See, if you have bought a great company, even Infosys, if you would have bought at the peak in the year 2000, you would have recovered your money after 6 years. You'll say, 6 years does it take to recover your money? Yes. But what if you would have bought a Pantasoft or a Silverline or a Mastec? That capital is gone 100% off. So it's all about what you buy. It's not about so much about when you buy. If you bought the best, you will get your money back. You'll get your capital back after 5 years, after 6 years. That's the worst case scenario. But if you bought the worst, then you won't get your money back even after 3 months.
Now, I want to talk a little bit about the portfolio management services. Now, why does somebody need that? Why do they need the help of a PMS?
No, frankly, if you can buy the strong, solid names on your own, you don't need a PMS. For example, there's this thing going around the world that why don't you just buy index funds? And the way the government has reshaped the Nifty, I think that it will be very difficult for most PMS and most mutual fund guys to beat the Nifty for the next 5 years. Because if you look at the constituents of the Nifty, the HDFC group is 20% of the Nifty. Any good portfolio would find it very hard to beat an index which is 20% in HDFC Bank. I think Reliance is about 13, 14% now. So 35% of the Nifty you're sorted. Again, if you put Infosys and TCS there, you put the Nestle's and HULs, 60, 70, 80% of the Nifty is strong and solid. But then the problem with the Nifty is Nifty won't make you rich. It won't make you outsized returns. It's going to give you GDP plus inflation. So maybe about 10, 12, 13, 14% every year. But if you want to make big money in this market, stock selection comes into the fore. So amongst the Nifty stocks, say the 50, one of them would go up 3 times over the next 3 years. But if you bought all 50 of them, the allocation aspect will ensure that you don't move too far ahead of the Nifty. So that's the differentiation that comes through. But if you're buying a mutual fund that owns 50 stocks or 60 stocks or 70 stocks, it's better to go and buy a Nifty.
Now, let me take a cynical view with regard to the PMS. Now, emotion is a very important factor in handling stock market fluctuations. Now, what emotional connect will a PMS have with somebody else's money?
I mean, it's also about trust. For example, like I can speak about myself, we put our own money into stocks 100% of the time, and finally, at the end of the day, our ultimate objective is to ensure that the capital goes back to the guy who's given it to us. So we have our own systems where if the market is doing badly, the first thing we do is to ensure that we can protect his capital. So we'll take a lot of safety calls. Safety calls not in the sense that we buy a Hindustan Unilever or something, but the focus there at that time is to ensure that if you've given me 100 rupees, I should be in a position to return back 90, 95 out of that back to you and say, sorry, boss, I lost 5 rupees for you, but this is all we could do. But if you look at it on a different scale, of course, we get benefited if the portfolio goes up. So how do we deal with it in that case? So if your 100 goes to 110, or if it starts recovering back, then we also start to open up. It's just like in your cricketing parlance, after you've crossed 50, you start scoring faster. And the moment you come to the crease, you first want to see the new ball off. So it's similar with us. You don't want to lose your wicket in the first over. So that's what we do. But mostly, yes, it's true. It's a bad name. People have done umpteen number of things with somebody else's money. But that's how the world, it's there in every trade. It's there in every game.
Let's get to the advisors, the so-called financial advisors. Now, they most of the time tell their clients to buy X, Y, Z or ABC. Now, what is important here is they don't themselves have any of those things that they're suggesting others to buy.
Most people in my industry, unfortunately, have bought real estate. They will have one house where they stay in. They will have another house where they've rented it across, and then. But that's how it is. I mean, I don't know what to say. But if you ask me, 100% of our money is into stocks. We are only into stocks.
I have read, and you also. We would have, obviously, I'm sure you would have read, you would have heard a lot of people, trusting these financial advisors, and then ending up bankrupt because it's happened over generations. It's happened on a regular basis. That's why I asked that question.
No, for example, off late, I see there is a new thing on the social media website where you pay 2,000 rupees and I show you how to make 10,000 rupees in a day trading. So it looks very good. And everybody says it only costs 2,000. Let's do it. So most of these guys are professional trainers who make more money training other people than they would by using all that they use to train others, by using that technique to apply on the screen. But that's because people are ready to be led into it. There is a Pied Piper everywhere. So it's for the guys out there to understand what they want to do.
Do you advise day trading to the uninitiated?
No, not at all. Not at all. I mean, day trading is a mug's game. See,
Because it's
Lablavi, any kind of trading will ensure that you go to zero, because the moment you start trading, you would trade only for amounts that are bigger than the capital you can put into the market, right? So if you've got, say, 10 lakh rupees and you've taken a position of, say, 50 lakhs, and the stock goes down 20%, you're wiped off to zero. But if you bought only 10 lakh worth of shares with 10 lakh rupees, and if it falls 20%, you still have 8 lakhs with you. So if you are trading and big money has been made by trading, and I don't say trading is bad, but you should know how to trade. If you are trading, then you should know that the moment the stock moves against you, you have to cut your losses and run. And that's what people don't do. They say, भाव आएगा तो बेच देंगे, भाव कभी नहीं है. The price at which you want to sell a stock and the price at which you want to buy a stock never comes.
now there are whispers you hear now and then about manipulation happening. Does it happen? Is my first question. How often does it happen? And if it happens, are there any pointers to detect them?
Manipulations happen, yeah, true. How does it happen? Nobody knows till it's been discovered that it's happened. But there will always be some, but then manipulations won't happen beyond the top. I mean, within the top 50, top 70 companies normally. They happen mostly in the small type companies, those isolated names where somebody would get into it and then the stock price goes up. But then nobody puts a gun on our head to buy that company. We can always choose. For example, a Nestle, for example, a Hindustan Unilever, an Infosys. I mean, there were talks about a whistleblower and Infosys also, but then still nothing happened to the stock price. So manipulation happens everywhere. I mean, in every industry, every trade, every game, every sport, there will be betting. There'll be people who would be trying to cut corners. But then that's a part of the deal.
If you were to nominate three attributes that are important for someone to succeed in the stock market, what are they?
First is the passion. He has to be wild about the markets. I mean, if I can elaborate there further, if he goes to a party and he finds out that nobody's talking markets, is he getting bored or is he enjoying the party? If he's getting bored because he's been to a party where nobody's talking markets, then I think he's passed the first test. If you have passion, that's going to encourage you to read and learn and analyze and move forward again. So second part is the learning aspect, the reading aspect of it. And third is the risk-taking ability, where you know how much risk you can take. We take enormous amounts of risk in our portfolio, personal level. And my entire story has been built by taking risk. So I used to borrow shares from my maternal uncle and pledge it to a bank, take money, and because I always had this back calculation with me that if this doesn't work out, then I mean it's not worth staying with little amount of cash. I mean, if you want to make it big, just make it big. It was like that.
At one stage, obviously, somebody has to go easy on taking risks. What would that stage be? Is it in the 40s or 50s, especially for salaried people?
For salaried people, I think they shouldn't be taking risks at all. And I will tell you why. Because, you know, it takes so much of effort to make money. And I'm pretty sure if a salaried guy takes a risk, comes into the market, and if he loses money, he's going to leave the market. So if you've left the market, then how do you recover what you've lost? If you're in this as a full-time guy, you can take some risk. So risk here, I assume, means trying to make bigger returns than what is necessitated. But then for a salaried guy or for anybody else, he should always be putting money into the top-end stocks, and then over a period of time, he's going to make money. That's not a problem at all.
Now, what would you tell people that buying a stock by itself is a risk? What do you have to say to counter that?
It depends on what stock you've bought. If you bought...
Okay, now you spoke about attributes that are required. So once a person has those attributes, are you trying to convey to people that it is definitely something you must do, invest in stock market because the chances are really good enough for you to at least make a profit, not really sort of land in millions?
No, it depends. If you've got a lot of money, then why are you coming into the markets unless you have a first-hand information of how things happen? Because this cuts both ways. It's not so easy that you can just come into the market and make a lot of money and double or triple your money. So, I mean, it's all a function of what you want from the market. If you want to make normal, regular returns, then you can do that in fixed deposits also. But if you want to understand the markets, then you have to put in money. But then it's not so easy as it appears that everybody, I mean, it's not a fundamental right for every Indian to make money out of the stock market. And I think 9 out of 10 people don't make money out of the market because they come in at the wrong time and they leave the markets at the wrong time.
Now, I want to know what exactly is currently going on in the stock market. Companies have been shut. There's been a lockdown in this country. Now you suddenly see a rally happening. What exactly is going on?
So markets don't like uncertainty. They are okay with the worst. So it's like somebody coming and telling you there's been an accident. So the head of state was in that car. We don't know what's happened to him. The moment he says we don't know, the market says wow, nobody knows. So then you start thinking wild. But if somebody says the head of state died, then you say okay, no problem. If he's died, let's choose somebody else and put him there on the top. So if you see, the US market started moving up the day Donald Trump came and said America would have 80,000 to 140,000 deaths. So the market got a number. They said, okay, let's figure out this number and work around it. And now, right now, what's happening is, of course, the $8 trillion that's been printed, that's chasing stocks. And secondly, and more importantly, every passing day, you come closer to a vaccine. Every passing day. So now you can say, if I can spend 2 months sitting inside doing nothing, there's a Pfizer who's trying to do something, there's an AstraZeneca who's trying to do something, and there's a local Babaji who's trying to do something. So you don't know, somebody might get a vaccine someday, but then it's for you to decide which vaccine you can try. So I think now with every passing day, you come closer to a vaccine. The last 3, 4, 5 months is behind us now. But then for the companies that have been wound up, like a Hertz, for example, a Macy's, for example, an Airbnb, for example. I read this quote about that CEO saying what we created over 12 years got destroyed in about 12 weeks or thereabouts. But that's tough. That's a part of the game. But then you can say, was he foolish? Why did he do all that? But had he not done all that, we wouldn't have known about Airbnb. So there are no right answers here. To grow in life, you have to take leverage, you have to take risks. And if you hit a COVID, bad luck.
One of the viewers here wants to know what is the sector to focus now?
If you want to really make big money, if you want to really play hard in India, buy the best financial names. If you really want to play it safe, if you want to play with a fair degree of risk control, buy something connected to the internet. Because if you would have seen over the last 8 years, over the last 10 years, most of the money in America has been made out of technology stocks. The fancy name that we say FANG, Facebook, Apple, Amazon, Google, Netflix, and then you add a Tesla to it, you add an Alibaba to it, you add a Baidu to it, you add a Tencent to it. If you remove these companies from the list, the Walmarts and the Macy's and the Unilevers, they have not made too much money. The pharmaceutical names haven't made too much money. So the new big thing, the new black box, the magic box, I'd say, not the black box, is going to be technology and internet. But then you have to know how to play that game. If you don't know that, if you just want to play good, hard, solid, you buy the best financial names because most of them were priced for bankruptcy, as if these companies would never ever. And WV, one thing to understand was, if the best banks in India go bankrupt, if the best NBFCs in India go bankrupt, India itself has gone bankrupt. What else is left in India? So at some point you have to sit back and say, no, all these banks and NBFCs cannot go bankrupt. But if you want to play it very safe, you buy the Nestle's and the Unilevers, no recommendation what we say. But then those companies, you're going to make only 12-15% over a period of time.
Thanks a lot, Basant. Thanks a lot for your time and for your wonderful insights into what is considered an enigma. The stock market always remains an enigma to many people. I really appreciate for you coming over on the show. and wish you all the very best in all your future
And
trades,
before we
endeavors.
end, the first time we got talking, I remembered you playing the Chennai test, and I think you got caught at mid-off on the next day morning. You were due for 100, you couldn't make it from, if my memory serves me right. So that's my memory of you, and I was really pleasantly surprised because, of course, I wasn't very good to be playing cricket at all. But then, if I got a chance, I would go to school, come back. If there was an India-Pakistan game, I said I was late to school and they didn't let me enter. So twice it happened. The third time, my dad took me to the principal's and he said, "No, this guy didn't come to school at all." So it's really an honor to be interviewed by you.
Thank you very much, and stay well, stay safe. Good night, Basant.
Good night.
And for the viewers, the next guest of mine in my episode is going to be really special. I look forward to your company then. It's going to be on Tuesday. Like I always say, stay safe, subscribe for this channel, and hope to catch you around on the Tuesday. And I look forward to your company then.